Mark Perchtold has come into our studio straight from the airport. You've been doing a bit of a roadshow in South Africa.
I have. I've been in 3 different cities: Johannesburg, Port Elizabeth, and then Cape Town, and now back to Joburg before heading off to London.
Okay, Aberra, as it's now known.
As it's known, I'm not the best at the pronunciation.
Well,
when I left South Africa, it was still Port Elizabeth.
How long have you been out?
18 years now.
18 years. And Omba, your company in London, we'll talk about that in just a moment. How's that been going?
Yeah, it's good, going well. We're up and running. It's been 5.5 years now, so we're no longer a startup, but we're still a young firm. And we've covered a lot of ground. You know, one of the biggest hurdles these days in setting up a financial services firm, particularly in a jurisdiction like London, is regulation. So we've overcome a lot of regulatory hurdles getting regulated in the UK, South Africa, Switzerland, and also by the Central Bank of Ireland.
That's a lot of regulations.
Yeah, and they differ, you know, the permissions in each jurisdiction, but we're up and running in various respects in those territories, but the primary ones being, for us, the United Kingdom, and then obviously South Africa.
Why do you need the others?
So we've got some clients from Switzerland, and in order to advise them in Switzerland, you need staff members to be approved advisors in Switzerland. So we have that set up for some of our staff. And then we also have our funds available for distribution in Switzerland. So you need that to be approved before doing so, similar to South Africa, where you have to get Section 65 approval before a foreign fund can be marketed here.
So if you were to go into Germany, you'd have to go through those
similar hurdles, exactly.
Hurdles as well.
It's easier because our funds are Irish, and Germany's part of the EU, so you would get passporting across the EU, whereas Switzerland's not in the EU. It's a separate regulation.
And you're in South Africa now, obviously here the BizNews office is in Riot.
Physically, yeah.
Do you have many South African clients? Is that the reason for coming here?
We do. We're probably 50% South African clients, 50% is called mainly UK, but some other jurisdictions. Many of our clients are actually...
How come the South African connection?
Well, it's because of a few things. One is our team are made up of a number of South Africans living in London, so we have a South African centricity to us. But I was at a big American bank and the head of the team there for when I left, covering the South African market. So was traveling back here from London for many, many years. And so built relationships in South Africa and retained relationships in South Africa over that period, which you don't want to give up. So it's a natural go-to territory, and it's great to come and visit. You know, we've got friends and family, so it's always good to get back.
You're 18 years, but you are still South African. We have relocated South Africans, no ex-South Africans, according to Jeff Johnson, who, I don't know if you've managed to meet Jeff, but he's one of the very proud flag wavers in London.
Yes, I have met him.
You know him, and he calls the UK the 10th province of South Africa. And I guess there's so many South Africans there now, it may as well be a 10th
It's province. Really getting crazy. I'm part of a WhatsApp group for old boys from a particular high school, the one I went to, King Edward VII.
Oh, well, that's good, because if you'd gone to Michael's house, you would have told us.
Well, you asked me. I got the joke. Anyway, so there's a WhatsApp group for UK and EU old boys that has increased from 60 members to 170 members since COVID started. And those are people arriving from South Africa.
Mark.
Quite worrying.
Well, as long as they retain the connection and hopefully one day we'll be worthy in this country of pulling people back home. And that's, I guess, what part of the role is for those of us who are looking forward to post-2024. But from your business's perspective, Omba, it's a really, really interesting model. And if you were a financial advisor. In fact, I spoke with Anthony Ginsberg, another South African, this time he's living in San Francisco, yesterday, and he said what he advises people to do is to get exchange traded funds as their core, as their base, and then to get alpha or outperformance, you get a few active managers that you really believe in. Now, your whole business model is something very similar to that. Just unpack it. I know we've spoken about it before, but in a nutshell, just tell us how it works.
So traditional portfolio theory will tell you that the more bonds you own, the less risk you have in your portfolio, and the more equities, the more risk you have. And bonds and equities are the core building blocks of portfolios in the main, particularly in the retail investment world, but also for many high net worth investors, that will make up the bulk of a portfolio. You have obviously private equity, hedge funds, venture capital, other asset classes, which make up a smaller portion. But for the most part, it's equities and fixed income. And the approach could be to go and pick shares or go and pick bonds or to go and pick managers, as many financial planners would do. They would have managers in a portfolio. They would use Coronation and Allan Gray and 91, Sanlam, Ford and Old Mutual in South Africa. So that's picking managers, and you might have a discretionary fund manager pick those managers for you. And what we've seen through various research, or lots of research we've done and various reports we've read, is that a lot of managers' net of fees don't beat their benchmark. So if you selected a group of managers across the globe, let's say you wanted an Asian manager, a European manager, and a US manager for your various exposures around the world, net of fees, many managers don't beat their benchmark. And I think I mentioned to you the Spiva reports before.
Yeah. In other words, after costs, when you say
net of fees, net of costs.
And the benchmarks being?
Benchmarks being the major indices that you could just own through an ETF.
A low-cost ETF, which would then be a very small
cost. I mean, some ETFs are actually free. You know, the zero-priced ETFs now, which sounds strange, but they make their money through scrip lending, but they exist. But let's say in the main, the large markets of the world, like the S&P 500, the Stock 600, the FTSE 100, the Nikkei 225, etc., these major indices, you can get ETFs for 0.05%, 5 basis points to 10 basis points in pricing. So you own all those underlying companies. So you inherently have a great diversification.
Just for those who losing us, or who we losing, it's like an index fund. It's a balanced portfolio of that index. So when you hear the Nasdaq has done X, Y, Z, you know that's what's happened to your index, rather than when you give money to a fund manager, he would invest it in different shares.
Yes, exactly. The way I use a simple example, the FTSE 100 is the largest 100 companies listed in the London Stock Exchange by market capitalization. And stocks enter and leave that index. You can be a stock picker in the UK market and pick 20 shares from those 100. Or you can say, you know what, I just want to own all 100. And you can own that index. And that's what an ETF allows you to do. So it's a useful tool to get broad market exposure. And it's very low cost. But in the evolution of ETFs, you now have sectoral ETFs. You have country-specific ETFs.
So sectoral meaning what?
Sectors. So you could own the telecommunications sector. You could own the energy sector. You could own the
so those would be
utility
shares
sector.
In telecom shares. So if
like the pharmaceutical sector in Europe, there's a European ETF we've actually invested in before. It owns all the large pharmaceutical and healthcare companies like Novartis, Roche, GlaxoSmithKline, etc. Instead of picking one of those great multinational companies, you own all of them. And there may be a tail of smaller ones you've never heard of, but in the main, you would own all those large companies, but all healthcare oriented. And similarly for countries, you can own the Mexican market, and you can own a Mexican ETF, which we've done before because we wanted specific exposure to Mexico. Or you could own a China-focused one, or you could own a South African one. There are South African ETFs on the South African stock market, as you would know from core shares and Satrix, etc.
Can you buy them in Europe or in the United States, a South African market?
There are some from other big issuers. So it depends on, so that's sometimes a challenge. It can be a challenge, and that's so maybe where an active manager might be interesting to consider. So for certain markets, like for example, Vietnam and Indonesia, which we've looked at, there aren't ETFs in Europe that we could get exposure to those markets. So if you wanted access, you would have to go and find an active manager in that territory that you could.
I say that because talking to John Bickard, Piet Viljoen, Anthony Vincent, even Sean Pesh, they are, and I say even because he's also based in London, they're saying that the South African market is cheap. And if you were then, as a South African, maybe somewhere else in the world, you might be wanting to invest in this stock market. Could you do it in New York or London? Or
you can. I mean, yes, you could get access.
There is a way of doing it.
There is a way of doing it, yeah.
Before we move off onto that, though, so your business then has these exchange-traded funds that you invest in, which means presumably costs are real important to you.
Yes, well, we actually select the ETF. So we've become ETF specialists. There are over 8,000 ETFs in the world today. And so if you've made the decision to build a portfolio using ETFs, as we've done, we're specialists. So we will ensure that we select good and credible ETFs from credible providers that meet all sorts of criteria like adequate liquidity, tight bid offer spreads, right time of day for trading. We've got to consider, do you trade early London
Invert
time?
it for us a little bit. Are there bad ETFs?
There are some. Yeah, some. So historically, synthetic ETFs were frowned upon. They're actually not that bad, but we prefer to use physically backed. So I think synthetic ETFs have evolved.
What are synthetic ETFs?
Synthetic ETFs would be using derivatives and swaps facing a bank, so you have counterparty risk. So if the bank went bust, like a Lehman Brothers or Bear Stearns, you would get zero back on your swap contract because it's you swap the return of an underlier index. And those were historically frowned upon. There's no reason to frown upon them necessarily, but you've got to understand what you're buying. Some ETFs are very small. They've been launched recently. They sound really exciting, but the market capitalizations are tiny, and the ETF issuer might end up shutting it down. So if you've invested client money in it, it may do quite well. You then might be a forced seller, and you have tax consequences potentially where you have CGT events.
So the costs from your side, what kind of costs, or how important is cost? Because this is now the subject that we're looking at in great depth in South Africa.
I mean, that was one of the things we wanted to do. We wanted to offer a better solution to retail investors who are often overpaying. That was our end goal in setting up our business. We started dealing primarily with ultra high net worth and family offices, but many friends and family and people we knew said, can you not do something for us? And so as we've evolved, we've now launched funds where we cap our total expense ratio. And our fee as a manager is 0.3%. So ETFs themselves are low cost, and then we're not being greedy by taking a big fee. We don't take performance fees. We just charge 0.3%.
It sounds very low. And when I had this conversation with Peter Kukumur at Coronation, he said, yes, but you're comparing apples with pears, because people offshore, i.e. like Omba, have got all kinds of other costs that will have to come through for the investor. Whereas if you go through Coronation, it might be 1.5% as against 0.5%, or in your case 0.3%, but actually there we don't have any other hidden costs to it. Is that true?
To be honest, it is expensive to launch a credible fund. So our funds are in Europe. They're in Ireland under the UCITS regime, which is a very respectable regime, which affords investors some level of comfort because there's a lot of regulation around the UCITS regime. In doing so, you've got to consider your depository or custodian. So, we use a blue chip custodian, being Northern Trust. You've got your administrator who's going to administer.
So these are additional costs.
These are additional costs.
So what does it all come up to?
So in our moderate fund, which is our largest and first fund that we launched, to give you an indication, we've capped our total expense ratio at 0.8%. Currently, based on the size of the fund, all the costs come to around 0.65%. 0.65%. So
with the custodian and the regulation.
Exactly.
Yeah, but that's a long way from 1.5%.
Yeah, and then we can't draw our 30 basis points. So we're only drawing 0.15 currently. So we're actually not about to retire because we're not being greedy. We've capped it. So it's quite a unique structure. In fact, the regulator, when they looked at it, said, we've never really seen this before. Because normally what happens is when a fund is small, it's passing through all those extra costs to the investors, even though the investment manager, as we are, is charging its full fee. So instead of us charging our full 0.3, taking the fee up to 0.95, we're not. We capped it at 0.8. So we're charging 0.15 in management fee.
Okay,
now,
without getting
argue,
too detailed in it, if I understand correctly then, the figure that Sean was quoting, which was 0.5%, 0.5%, if you're an offshore fund, you can probably add another 0.5% to that through the add-ons that you mentioned before, because it seems like if you 0.15
no,
to
I mean,
0.65.
Sean was also referencing from memory the largest funds in the offshore market, and many of those are actually ETFs, exchange-traded funds. But when a fund gets bigger, a lot of those costs come down in terms of percentage of AUM, because there's a fixed fee element, which is why there's such a barrier to entry in launching a fund in a credible jurisdiction. There's a huge barrier to entry because a lot of those fees are basis points fees, but there's a fixed fee component, and it's the fixed fee component that makes it expensive when you're small. So $1 billion fund or $2 billion fund will have a very different ongoing cost structure.
Come a bit closer to the mic, we're going to lose you.
We'll have a different ongoing structure to a small fund.
All right, get it.
Yeah.
Where are you now? How are you viewing this? We are here at BizNews getting information from the experts we talk to that the run of the growth is over. Nasdaq is in danger of falling significantly in months to come. This is the time for value funds to come back. That's the story that we're being given. Is it one we should be buying, and is it one that you are buying?
I'm not as bearish as many market participants out there at the moment. I think we've already come quite a long way this year in terms of a correction. I mean, the Nasdaq peak to trough was 30% odd. If you look at the technology-specific sector, it's down over 40%. So, and the Nasdaq, by the way, is not only technology, although it's associated with technology. There are actually other sectors therein. I would say one should be cautious of the type of growth you want to own. There are a lot of businesses that have listed, that have raised money, that have never turned a profit, and they are now, things are coming home to roost. So it is correct that many of those companies have fallen 80 or 90%.
And they
in
should.
some instances, because they should. They have defunct business models. They've funded their businesses on cheap capital that is no longer available, whether that was debt markets, because funding rates were low, or equity markets where people were willing to throw cash into the equity market. That world's gone away. But in my view, big blue chip companies that have strong cash flows, that have incumbent client bases, that sell good products and services, that are now trading on low multiples, which may not be super low, in talking in the growth space, they've come down maybe to the mid or low 20s in some instances for the larger capitalization companies. For me, those are it's now the time to start buying them. I'm not saying this is the low. It's impossible to predict the bottom. But it's when it feels most painful and difficult that one should begin investing into the market.
So you wouldn't be selling Amazon, Apple, Microsoft?
No, certainly not. I mean, Amazon has got all sorts of levers it can pull in its business to generate a profit, and it's got a very strong and loyal customer base. So, if Amazon started doing starts doing new things, people normally start adopting them quickly, and it can roll out anything at once So a lot of the mega cap tech companies of the world control so much of our lives inadvertently, or involved in so much of our lives. So I wouldn't stay clear of those, but I would be very cautious of some venture capital, of some of the public listings that have taken place of companies that never turned a profit. So if you're a stock picker, just be very wary of those. And then, in debt markets, I think, there's been a lot of private lendings that's taken place around the world because banks stepped away post-GFC from risky lending under all sorts of regulatory capital requirements. And what emerged was this private lending market where you've had family offices and private lending funds launch and fund businesses, often on very covenant-light terms. And these types of deals, I think, are going to run into some trouble over the next 18 months as interest rates keep rising.
But Mark, private investors are not really invested in those private equity things. They're more looking at the FAANGS, for instance. Now, John Bickard was quite outspoken in our discussion. He's a deep value manager, admittedly. And he said he thinks Nasdaq can fall 50% and that the FAANGS can go, that's Facebook, which is now called Meta,
Yes.
Amazon, Apple, Netflix, Google, which is now Alphabet, that they could fall 50% is what he was looking at. Do you think that that's an alarmist approach?
I think, it's fallen 30 already. Could it go another 20? I think it's possible.
No, he's talking another 50.
I don't think another 50.
Mm-hmm.
That's very unlikely in my view. Very unlikely. I mean, if you think of the global financial crisis and the peak to trough drawdown in the S&P 500, I think it's just over 50%, which is meaningful. But then it starts to recover. So that was a globally systemic,
But if there's high inflation,
crisis.
that was his thesis, is that inflation is being maybe underestimated by the markets, in that they think that inflation in America is going to go down to 2% next year. And his view was, hang on, we've been creating all this money. That's not going to happen.
I think you could argue that we could potentially have deflation. I listened to a very interesting presentation about potential deflation, and some of the arguments are logical. If you think about what's been happening in the last decade, you've had central banks like the Federal Reserve, the ECB, the Bank of England, the SNB, the Bank of Japan keeping rates negative, super low, coupled with quantitative easing, and they've been unable to stoke inflation. So what's triggered inflation now is partly a post-COVID pandemic supply chain bottleneck issue, a Russia-Ukraine invasion and the energy crisis, and that's sort of started to feed into wage inflation, which is that for me is a worry, a wage inflation spiral. But given that those can easily reverse, in terms of the energy problem, and supply demand starts to rebalance and organize itself, and supply chain disruptions are already abating, you could see a world and demand destruction has occurred if people start spending less and worrying about a recession, and interest rates are higher, and so there's a slowdown as we're starting to see. Then you could start to see prices come down of a basket of goods, and so I don't think inflation is going to be this high for much longer. And your base effects are also meaningful. Once something's inflated, you're now at a higher level. So I think there's a lot of alarmist concern out there about inflation. But if you think for 12 years post GFC, more, you've had negative on zero interest rates and no inflation. And the reason for that is quite simple. You've got globalization, So goods and services can move more easily, and so could labor. You've had technological advancements, and you've got more humans on the planet than ever. We're going to 8 billion people, many of whom are more educated, more urbanized, and willing to work. So that can bring down wages because you've got more people who can do the job, and you've got technology, and you've got globalization. So why does there have to be inflation?
That's a very good point, and it is the point that was believed, or rather embedded into most analysts' thinking up until fairly recently, that the big worry, and deflation is much worse than inflation because you just don't buy anything if you know you're going to be able to get it cheaper in a month's or a year's time. So that was the big argument, but it seems on Wall Street that Mr. Market has a fairly short attention span, and the attention span at the moment is we've got to worry about inflation. We saw what happened this week, where the inflation number in America missed. Was it by 2?
Well, the year-on-year number was 8.3 instead of 8.1.
And the market came crashing down, 5% down.
Because it was higher. Because people were hoping it was online or
so low. Is this Mr. Market, or is this just a phase we're going through, or is there a real danger?
The market's worried that the Fed might have to become more hawkish and hike quicker. The Fed have already moved meaningfully, and we're still yet to see the pass-through of that into consumption in the US, which is the biggest driver of GDP in America. And you're going to start to see that quite soon. I mean, mortgage rates in the US are now, 30-year mortgage rates were up at 6% odd. So, it's getting more expensive to buy a house. You're starting to see changing dynamics in the housing market in the US with increasing inventories of homes, new home sales dropping. So there's a slowdown happening. This high interest rate regime is starting to kick in, and eventually people will consume less. And if you're a seller of a good or a service, you will drop your price to sell it. So I think within 6 to 9 months, we'll start to see inflation numbers coming in.
And the base effect there is also quite important, as you say. Just explain that.
So just that you're coming off a higher base, so prices can't keep rising at that same pace forever once you're at a very high level. So, that's something that investors need to think about, is that, we've already inflated in a lot of things meaningfully, and then you start to have demand destruction. Eventually people won't use as much energy because it's just too expensive. So you talk about the UK at the moment, you're seeing an energy crisis across Europe and the UK, and everyone's terrified about the winter ahead. And the governments around that part of the world are scrambling to come up with plans, whether those are incentives to give people handouts of cash or cap energy bills. It's a concern, but if households' energy bills are just too high, they will stop using as much energy, and there will be improved energy efficiency, and there will be a transition to maybe clean energy quicker. There may be a move back to nuclear. So there are lots of things that can adjust, and so energy price, oil prices and gasoline prices won't stay that high for that long.
It's a wonder of the capitalist system. You drive around here in Johannesburg, we're in Bryanston, quite close to Randburg, and along the main road of Randburg used to be Motor City. You would have all the, or not all, but many second-hand motor dealers. And they are now being replaced. They replaced in turn more upmarket businesses. They are now being replaced by storage operations and,
distribution
residential. Residential office blocks are turning into residential. And I suppose that's something we've never underestimated, is that capitalist societies do change. And when circumstances change, don't think they're going to continue in that way indefinitely. There will be adjustments, and it's a very complex world we're living in.
Yeah, and I remember during the COVID pandemic, when you had a 34% drop in the MSCI World Equity Index in dollar terms in a month or so, it was a very scary time, and you had to reassure clients and investors that we deal with that demand for toothpaste and toothbrushes and toilet paper has not dropped 34% in 1 month. So it's oversold. The companies that sell, let's take a consumer staple company, those stocks were also down meaningfully. Had the demand dropped that much that their earnings... So there's often a mispricing of risk that occurs when people panic.
Is it happening now?
I think people aren't yet at full panic mode at the moment, because there are still people, maybe perhaps like ourselves, that are reasonably optimistic given the correction we've already had. But I think the three bubbles I've spoken about, I've touched on the private lending markets, I've touched on some of the venture capital funding that I've seen, crypto and a lot of that. ecosystem has been an outlet for excess money supply. You've started to see corrections there. But fundamentally good businesses can potentially thrive in a dislocated environment, because disruptors who had defunct business models and were launching their businesses on cheap funding are going to fail, and the big players will take them out. And so those businesses might actually do quite well. So they'll pick up some more market share that they lost before. So when stock prices correct too much, eventually big adjustments start to take place. And I'm of the view you've got to begin buying into the dip. And it's a very difficult exercise, which we've tried to model sort of academically. When do you begin buying the dip, and in what increment do you buy the dip, moving from cash or bonds into equity? And I won't go into all the detail because that's probably a 15-minute conversation. But the bottom line is you've got to begin somewhere after 10% drawdown, and you've got to be doing clips every 5%.
10%, just explain.
Drawdown. So as the market's fallen, once it's fallen 10%, you need to begin your process, because you don't always fall more than 20. So people may not know this, but the European sovereign crisis, when the pigs, as they were called, Portugal, Italy, Greece, and Spain, were all in crisis, and their credit spreads had blown out, and they were worried about the state of the EU and all the rest of it. That was 2011. The drawdown in the global index was not more than 20%, but it felt like a really rough period. It was the first sort of crisis post the GFC. And if you'd done nothing, you wouldn't have bought that dip. So the dip now might be 30% on the global index. We haven't got there yet. We're sort of circa 20. I can't predict that. But to sit on your hands and do nothing is a mistake. If you have excess liquidity, you need to begin deploying. And it's easy to talk yourself into a world of Great Depression and disaster and Armageddon, because people love to be negative and bearish. And that's often what causes an overselling of the market. So our view is, take some more risk now in the dip, but do so thoughtfully, depending on an investor's liquidity and how much excess capital they have.
Mark Perchtold is one of the co-founders of Omba, and I'm Alec Hogg from BizNews.com.